I've always believed that the borrower is slave to the lender because, in essence, your most powerful wealth-building tool is your income. When you aren't locked into payments to creditors, you have the freedom to invest and build wealth. For example, the average car payment in America today is over $500. That's pretty crazy. If you took just $500 a month and invested it in a solid growth stock mutual fund from age 30 to 70, you'd end up with over $5 million. Isn't that incredible? Becoming debt-free and investing is one of the fastest ways to build wealth. It truly changes your financial trajectory, improves your retirement prospects, and impacts your future generations. It's a mindset shift that requires commitment, but the results are life-changing. The unfortunate part is, most of the financial industry focuses heavily on investing, yet overlooks the importance of getting out of debt to make investing possible. I've spent years in the finance world, holding degrees, licenses, and working with thousands of people. And what's astonishing is how many so-called financial experts out there have no actual wealth or track record of helping people succeed. Their advice often misses the mark, and they profit from the wealthy while ignoring the rest of us. When it comes to investing, I personally prefer a well-diversified portfolio of growth stock mutual funds. I split my investments across 4 types: growth and income, growth, aggressive growth, and international. It's key to select funds with a proven 10-year track record. Some might ask, why not just go with index funds? Well, you can, but I prefer mutual funds that consistently outperform the S&P 500, because if a mutual fund doesn't outperform the market, you're better off investing in an index fund. To choose the right mutual fund, always check its performance compared to the S&P 500. If it's underperforming, don't invest in it. But I'm also not a fan of the heavily commission-based loaded funds. While they can have a higher cost, having someone to guide your investments helps you stay committed through market ups and downs. It's easy to panic when you're by yourself and listening to negative news. The key to building wealth isn't just picking the right investments. It's about consistently saving and investing. Research shows that 74% of retirement success is determined by how much you save and invest over time. It's about the steady, disciplined approach of putting money into your 401k or other investments month after month, year after year. When picking mutual funds, I place heavy emphasis on their past performance. I like funds with stable track records, avoiding high-risk options. The 4 types of funds I recommend are: 1. Growth and income funds, large cap, blue chip funds. These are the stable, big companies that don't have huge volatility. They grow slowly but steadily, offering lower risk. 2. Growth funds, mid-cap funds. These are medium-sized companies that typically match the market's volatility. They provide a balanced risk-to-reward ratio. 3. Aggressive growth funds, small-cap, emerging market funds. These are riskier, smaller companies with the potential for higher returns, but they can be much more volatile. 4th, international funds. These funds invest in companies outside the U.S., offering diversification to protect against relying solely on the U.S. economy. While international funds may underperform U.S.-based companies in many cases, they still offer valuable diversification. You don't need to go all in on international stocks, but it's good to have exposure to global companies. Ultimately, the most important step is to actually do it. Many people talk about investing, but the real wealth building happens when you consistently put money into your investments over time. Millionaires didn't get there by betting on a hot tip or a lucky stock pick. They did it through consistent, informed investing. Avoid chasing the latest trends or trying to time the market. Stick to what works, spread your investments across different types of funds, and be patient. Your financial future will thank you for it. Lastly, remember that you need to fully understand where your money is going. Whether you're investing in mutual funds, buying insurance, or getting a mortgage, don't just trust the person selling you the product. Ensure that you know exactly how it works. Only then can you make your money work for you. Wealth doesn't come from luck. It comes from understanding and consistently doing what works.